Imagine you just opened a brand new brokerage account.
Right. You are super excited.
Yeah, exactly. You deposit your hard-earned savings. Maybe it is, like 10 grand.
Oh, man.
You stare at the screen, you feel this massive rush. You think the financial market is a fair playing field?
You think it is a place where smart people get rewarded.
But you are completely wrong.
I mean, totally wrong. It is a slaughterhouse.
Yes. It is a meticulously designed hunting ground. And, well, you are the prey. Welcome to our deep dive.
Today we were tearing into a stack of historical interviews. They were compiled by Jack D. Schwager.
Right. He was a research director at Prudential Securities.
And he spent years tracking down the world's most successful traders. He wanted their deepest secrets.
But what he found instead is a brutal, terrifying reality check. I mean, the data is just absolutely horrifying.
Oh, it is sickening. The average retail investor survives just 6 months.
Just 180 days. That is it.
That is all it takes for the average person to completely blow up their account.
Gone. Wiped out. Literally reduced to zero.
Meanwhile, a tiny, elite fraction of top traders are experiencing massive, incomprehensible growth.
We are talking about like 100,000-fold growth.
It is a terrifying contrast, and it completely shatters everything we are taught about money.
Totally. The average person walks into the market and relies on luck.
Yeah, they rely on gut feelings. Or the morning news.
And relying on those things guarantees absolute discretion.
Right, because the market is not a lottery. It is not a charity.
The masters do not have better luck than you. They hold the actual keys to the money printer.
Exactly. They understand the harsh, mechanical reality of the game. You are playing against apex predators.
People who have mathematically engineered their own survival.
Right.
So let's really unpack that dynamic. Think about a blindfolded person walking into a high-stakes casino.
Okay, yeah.
That is the retail trader.
Yeah.
You walk in, you think you are playing a fun game of chance.
You sit at the blackjack table.
Right. You pull the lever on a blot machine, you hope for the best.
You just pray the screen flashes green.
But the wizards, in Schwager's research, are not playing the slots. They are the ones who actually own the casino.
Man, that is such a perfect way to put it. They built the machines.
Exactly. They program the exact mathematical odds. They do not need to hope.
Right. Because they rely on cold, hard probability.
The house always wins, the public always loses.
It is an engineered transfer of wealth. Pure and simple.
And this raises, like, an incredibly important question. How did these wizards actually do it?
Smart. Schwager went looking for a single magical method. He wanted the ultimate formula.
He assumed all these billionaires must be using the exact same secret strategy.
But what he found was much stranger. I mean, it defies all conventional financial logic.
You want the secret formula for getting rich?
Yeah.
Here's the ultimate slap in the face. There isn't one.
Wow.
There is no secret math equation. There is no magic indicator that will save you.
Schwager interviewed top-tier traders across every conceivable market. Futures, options, the stock market.
And their methods are completely 100% contradictory.
It is insane. Some of these masters stare at price charts all day long. They look at lines and patterns.
While some of them refuse to look at charts. Instead, they read dense, fundamental economic reports.
Right, and some completely ignore the news entirely, calling it pure noise.
Some do not even make decisions. They just let computer algorithms do the heavy lifting.
They do not agree on a single technical approach.
It is totally chaotic. One guy says you must buy on the news.
And another guy says if you buy the news, you will go bankrupt.
Their methods clash violently, but they all end up at the exact same destination.
Massive generational wealth.
Unimaginable wealth. Why? Because their secret weapon is not their trading method.
Right, it is their attitude.
Exactly. What is fascinating here is the mental posture. The actual strategy itself is almost secondary.
The mental posture is the true engine of their wealth. It is the psychological armor they wear every single day.
They have totally reprogrammed their basic human instincts.
Yeah, they do not react like normal people.
Wait, I have to stop you there. Are you telling me the actual strategy does not matter?
Well, no.
Because that sounds like a massive cop-out. You cannot just think positive thoughts, manifest good vibes, and suddenly become a Wall Street billionaire.
Oh, for sure. The mechanics definitely have to matter. You absolutely need a mathematical edge.
Right.
But an edge is completely useless without the right attitude. Imagine giving a losing trader a perfectly back-tested winning system.
Okay, I am picturing it.
They will still find a way to lose all their money.
Really?
Oh. Because human nature takes over. They will panic when the system hits a rough patch.
Bah,
They will get greedy and double their bet when they shouldn't. They will break the rules.
So the mind is the actual weapon. The strategy is just the ammunition.
Exactly. If the weapon is jammed, the ammunition is worthless.
That makes perfect sense. The human element breaks the math. So let us look at the first wizard in this research.
Michael Marcus.
Yes. He proves that hitting absolute rock bottom is just the warm-up.
Totally. He didn't get rich by perfectly predicting the future.
No, he got rich by finally realizing exactly how stupid he was being.
Marcus is a legendary figure, but his start in the markets was truly pathetic.
He lost everything. Repeatedly.
He did what every desperate amateur does. He literally borrowed money from his mother.
Oh, wow.
And he took that borrowed money and blew it immediately. He bet his entire account on a rumor about corn blight.
Okay, wait. Explain that to me. What exactly is a corn blight rumor, and why did it destroy him?
So, corn blight is a disease that destroys crops.
Got it.
If the crops die, the supply of corn plummets. When supply plummets, the price skyrockets.
Right, basic supply and demand.
Exactly. Marcus heard a whisper that a blight was coming. He thought he had a secret tip.
So he bet his entire account on corn futures. He went all in.
Yes. But the rumor was false. The price collapsed.
Oh, man.
He was completely wiped out in a flash. It was a total, unmitigated disaster.
But then something in his brain snapped. He completely changed his approach.
He really did. He took a $30,000 company account and turned it into $80 million.
That is insane.
Yeah.
He multiplied that money 2,500 times in just 10 years.
That is not normal market behavior. That is not luck.
So what actually changed?
The math of his risk changed. He stopped betting the farm on rumors.
He stopped treating the market like a lottery ticket.
He learned to ruthlessly, violently control his risk. He locked his maximum loss per trade to strictly under 5% of his total capital.
Let us break down that math. If you risk everything on one trade, you have one chance to be right.
Right.
If you lock your risk at 5%, you get 20 chances to be wrong before you go broke.
Exactly. If an idea failed, he lost a tiny, insignificant sliver of his money.
It didn't hurt. It didn't trigger emotional panic.
He survived to trade another day. Survival is the absolute prerequisite for wealth.
It is exactly like a reckless street fighter. You go into a dark alley, you throw wild, exhausting haymakers.
You bet all your energy on one punch.
Right. You miss, you get knocked out instantly. Then you learn martial arts discipline. You stop throwing wild punches. You protect your chin.
You manage your distance. You become an invincible machine.
Once Marcus stopped betting his whole account, he became unstoppable.
Marcus learned how to survive. But surviving is only the first step.
Right.
The next wizard learned how to attack. He learned how to profit from the exact moments when the market makes absolutely zero sense to the general public.
Earning $300 million a year has nothing to do with knowing the morning news.
No, it is about betting heavily on the silence before the storm.
Bruce Kovner is an absolute monster in the global markets. He achieved an 87% compounded annual return.
For a full decade.
He turned $2,000 into over $1 million. He trades massive, world-moving global positions.
And his ultimate weapon is deeply counterintuitive. He bets on breakouts from tight price ranges.
Okay, pause right there. Zero jargon. What exactly is a tight price range, and what is a breakout?
Imagine looking at a chart of a stock or a commodity. For weeks, the price barely moves.
It just stays in a flat, horizontal line.
Right. It is a tight price range. The market is completely asleep. Buyers and sellers are perfectly matched.
Okay.
A breakout is when the price suddenly violently explodes out of that flat line, either shooting straight up or straight down.
Okay, so the price explodes. But Kovner has a very specific catch.
A huge catch.
He bets on these breakouts only when nobody understands why the price is moving.
Exactly. There is zero logical reason in the news. The media is completely silent.
Retail investors freeze. They see the price moving, but they wait for an explanation on television.
But Kovner does not wait for the television. He goes all in. That is when the risk-to-reward ratio is absolutely massive.
But I have to push back here.
Okay, shoot.
Isn't betting on something you do not understand just blind gambling? Why jump into the dark? If there is no news, how do you know it is not a trap?
Actually, it is the exact opposite of gambling.
Okay.
If we connect this to the mechanical reality of the market, the lack of public news is the actual signal.
Really?
Yes. It means huge, hidden, institutional money is moving.
Explain how that works mechanically.
Think about it. Big banks and institutions cannot just buy 1 million shares all at once.
Right. If they do, the price will skyrocket instantly and they get a terrible price.
Exactly. So they buy quietly, slowly. Inside that tight price range, they accumulate silently.
Aye.
When they finally finish buying, the price breaks out. There is no news because the institution does not want anyone to know they are buying.
The price is moving purely under the surface due to massive, quiet demand.
Yes. If you wait for the news to explain it, the big players are already done buying.
You are too late.
The retail crowd buys the news. The masters buy the mystery.
That is brilliant. The mystery is the footprint of a giant. So Kovner reads the hidden tape. He tracks the invisible footprints of the institution.
He absolutely does.
But what if you do not even need to know how to read the tape? What if you can just program a normal human being to do it?
This is wild. Great traders are not born with a magical gift. They can be mass-produced in a factory, just like farm animals.
This completely destroys the myth of the natural-born financial genius.
Richard Dennis proved this. He is the $400 legend.
He literally turned a borrowed $400 into $200 million.
And he got into a massive argument with his trading partner. His partner believed great traders were born with a special intuition.
Dennis believed trading could be taught to anyone.
So he put his money where his mouth was. He hired a group of total novices.
Security guards, actors, accountants.
He called them the turtles. He gave them a rigid mathematical system.
And the results were absolutely staggering. These raw trainees averaged a 100% annual return.
They mass-produced millions of dollars.
The harsh truth of this experiment: you can learn a winning trading system in exactly 1 week.
1 week? The rules are shockingly simple.
Buy when the price hits this exact number. Sell when it hits this exact number. Risk exactly this much money. That is it.
But almost no one survives in the real world.
Wait, if the rules take a single week to learn, why do 99% of normal people fail miserably?
Because surviving requires executing those rules with robotic, cold-blooded, absolute discipline.
You must completely and utterly abandon your human intuition.
You must ignore your gut feelings. Your gut feelings will destroy you.
Walk me through the psychology of that destruction.
Imagine the market is plunging, blood is in the streets.
The news is screaming about a recession.
Every fiber of your human brain is screaming at you to sell and protect your cash.
Right.
But your mechanical rules say hold. Or worse, your rules say buy.
Oh, wow.
To follow the rule, you have to step in front of a speeding train. You have to disobey your survival instinct.
You have to obey the math. It is pure, agonizing mental torture.
It is exactly like a diet. Everyone on planet Earth knows exactly how to lose weight.
Eat fewer calories, exercise more.
The instructions literally take 10 seconds to explain. There is no secret dietary formula.
But the execution requires a mental toughness most people simply do not possess.
You are stressed. You stare at the chocolate cake. You eat the cake. You break the rules.
The market is just a massive diet for your money. Most people financially binge when they get emotional.
Dennis built an offensive army of rule followers. They aggressively attacked the market using strict trend-following math.
But the next wizard in our stack took the exact opposite approach. He built an impenetrable fortress of absolute defense.
In October 1987, the stock market crashed violently. It was Black Monday.
The world bled. Generational fortunes evaporated overnight. People literally jumped out of windows.
But one man made a 62% return in a single month.
His name is Paul Tudor Jones. His secret: absolute crippling paranoia.
He boasts 5 consecutive years of triple-digit returns. That kind of consistency is historically unheard of.
How does he do it? He completely ignores his winning trades.
He never stares at his profits. He literally refuses to calculate how much money he is making on a good day.
He only stares at his potential losses.
He plays great defense, not offense. He operates under the bizarre assumption that every single position he holds is totally factually wrong.
He refuses to gamble before key economic reports are released.
The amateurs sit there and pray for profits. They hope the news comes out in their favor.
Jones obsessively manages his escape routes.
If you always assume you are wrong, you stay alive. You never get caught off guard.
But I have to push back here. Mechanically speaking, if you always assume you are wrong, how do you ever have the guts to pull the trigger?
Right.
How do you make any money if you are constantly terrified of losing?
Because paranoia keeps you incredibly agile. You cut your losses instantly. You do not freeze.
When a trade goes slightly against you, you do not sit there and hope it turns around.
You do not pray. You just react and close the trade.
By constantly cutting the small losers, you are engaging in a ruthless filtering process.
He throws out the trash immediately. What is left? Only the undeniable massive winners survive in his account.
He is ruthlessly pruning a garden. He cuts the weeds the second they sprout, so only the massive oak trees remain.
Jones trades constantly. He darts in and out of the market 100 times a day to protect himself.
But our next wizard proves the exact opposite. He proves that sometimes the ultimate weapon is doing absolutely nothing at all.
You have been told your entire life to diversify.
Do not put all your eggs in one basket. Buy a little bit of tech, a little bit of real estate, a little bit of healthcare.
That advice is a complete lie.
Wow.
Diversification is just a shield for the ignorant. It protects you from total ruin, but it guarantees absolute mediocrity.
Gary Bielfeldt proved this lie. He started his trading career with just $1,000.
He traded from a tiny, quiet town in Illinois.
And he became a colossal, dominating force in the massive treasury bond market.
He dominated the screaming trading pits of Chicago from the comfort of his quiet living room.
Before we go on, we should define what the treasury bond market is.
It is the market for United States government debt. It is considered the safest, most liquid paper on earth, and it trades in massive billion-dollar chunks.
And Bielfeldt treats this massive market exactly like a game of professional poker.
Think about a poker professional. You do not bet on every single hand you are dealt.
You throw away the garbage hands. 2 and a 7. Fold.
You throw away the average hands. A pair of 10s. Fold.
You sit there. You wait in the shadows. You wait until you hold the absolute highest probability card.
You wait for pocket aces.
And then you strike with massive, terrifying force. You push all your chips into the middle.
Bielfeldt masters his patience. He does not feel a need to constantly trade.
So what does this actually look like in practice?
It is the difference between a panic machine gunner and an elite sniper.
Retail traders are panic machine gunners. They spray bullets everywhere. They buy 20 different random stocks.
They hope to hit something. They waste all their financial ammunition on mediocre setups.
Bielfeldt is the sniper. He waits days. Sometimes he waits weeks without making a single trade.
He waits for the absolute perfect mathematical alignment. Then he pulls the trigger exactly once, and he hits the target.
Bielfeldt controls his conscious actions perfectly. He masters his impulse control.
But our next wizard goes much deeper into the human mind. Ed Seykota claims you do not even control your conscious actions.
He claims the market controls your subconscious soul.
This segment is going to make you sick to your stomach.
If you are losing money in the stock market right now, it is because deep, deep down, you actually want to lose money.
Ed Seykota is a pioneer. He built some of the very first computerized, algorithmic trading systems in history.
His returns are physically sickening. He achieved a 250,000% return over 16 years.
Let me repeat that. 250,000%.
And he did it while keeping his risk below 5% on every trade. He is an undeniable mathematical genius.
But his biggest, most profound discovery was entirely psychological.
Seykota dropped a psychological bomb in his interview. He said, and I quote, "Everyone gets what they want out of the market.
Even the massive losers."
No one on earth wants to go bankrupt. Nobody wants to lose their life savings. That makes zero logical sense.
You have to separate conscious desires from subconscious programming. People say they want to make money.
They consciously believe they want to be rich.
But their physical actions tell a completely different story. Some people trade purely for the adrenaline.
They want the thrill of the casino.
If they win too consistently, it gets boring, so they subconsciously sabotage themselves to feel the rush of danger again.
That is incredibly dark.
It gets darker. Some people trade specifically so they can lose.
Why?
They want to play the victim. They want to complain to their spouse. They want to harvest sympathy from their friends at the bar about how the market is rigged against them.
The market is just a giant mirror. It reflects your deepest, most hidden character flaws.
So, mechanically, how does this sabotage happen?
Think about a trader who refuses to cut a losing position.
Yeah.
They are down 20%, then 30%.
Why won't they sell?
Because their ego is in absolute control. Their subconscious desire to be right and not admit defeat just overpowered their conscious desire to make money.
They literally paid a massive financial fine to protect their fragile pride.
So if human psychology is that profoundly broken, maybe we shouldn't act like humans at all.
Maybe we should stop trying to be clever. Maybe we should act more like boring insurance adjusters.
Imagine a massive coffee trader. He buys and sells millions of pounds of coffee beans. but he never drinks coffee.
He does not care about the flavor of the beans.
He does not care about a drought in Brazil. He does not care about shipping lanes.
He only cares about the raw math of the price movement.
Larry Hite is that guy. He built the Mint Fund. He pulled in 30% annual returns on a massive institutional scale.
His ironclad, unbreakable rule: never risk more than 1% of total equity on any single trade.
Never, under any circumstances.
He openly admits he cannot predict tomorrow. He does not even try to guess where the market is going.
Predictions are for amateurs and fortune tellers.
He just uses the cold, hard law of large numbers.
Break down the law of large numbers for us. How does a 1% risk rule make him immortal?
If you only risk 1% of your account per trade, you can be completely disastrously wrong 20 times in a row. You will still have over 80% of your money left. You are completely fine. Your capital is preserved.
And because his winning trades make much more than 1%, the math guarantees that over thousands of trades, he will come out massively ahead.
It is ultimate mathematical immortality.
It is exactly like being the casino house at a roulette table. You are the casino owner.
You do not care if a random player wins one hand. You do not sweat a single spin of the wheel.
Because over 10,000 spins, the green zero on the wheel guarantees the house edge.
The odds are mathematically locked in your favor.
You just have to survive long enough for the math to play out. Hite survives by risking almost nothing.
Hite trusts the cold math. He trusts the law of large numbers.
But our next wizard, Michael Steinhardt, trusts something entirely different.
He trusts that other highly paid professionals are complete emotional idiots.
You want to know the absolute best time to bet against the market?
You wait until every major institution on Wall Street agrees it is a sure thing.
Steinhardt beat the market for 21 straight years. He created 30% compounded annual returns.
His core strategy was called variant perception. He actively hunted down the institutional consensus.
He found out what every hedge fund manager, every analyst, and every television pundit agreed on.
Then he aggressively bet against them.
Mechanically, why does this work?
When the buying frenzy is at its absolute peak, purchasing power is exhausted.
Think about it. If everyone on Earth believes a stock is going up, they have already bought it.
There is literally no one left to buy. Every available dollar is already in the market.
That is exactly right. The demand side is mathematically empty.
That is exactly when Steinhardt sharpens his knife. He shorts the market. He massacres the herd.
Let us explain shorting really quickly. Shorting is borrowing a stock, selling it at a high price, and hoping the price crashes so you can buy it back cheaper and pocket the difference.
But it sounds incredibly dangerous. If you step in front of a speeding train of Wall Street consensus, won't you just get completely crushed?
How do you not get run over by $1 billion of buying pressure?
Timing is the only thing that matters here. Steinhardt did not just get against popular ideas because they were popular.
He waited until the trend was fundamentally exhausted.
How do you measure exhaustion? How do you know the train has stopped?
You look at the momentum. The price stops making new highs despite positive news.
The trading volume starts to dry up. The shoeshine boy is giving you stock tips.
The last, most hesitant buyer has finally put their money in.
The train has run completely out of coal. It is just coasting forward on fumes.
That is when Steinhardt drops the hammer. He shorts the frenzy when it is physically incapable of going any higher.
Steinhardt shorts the frenzy. He bets on gravity.
But William O'Neill does the exact opposite. He buys the frenzy.
But he only does it at a very specific, terrifying moment.
90% of people are completely paralyzed by the fear of buying a stock at its all-time historical high.
It feels deeply wrong. It feels like you missed the boat. It feels dangerous.
But that fear is exactly what is keeping the retail public poor.
O'Neill created the famous CanSlim method. It is a massive screening system.
He screens 7,500 stocks. He looks for rare, hidden gems with huge, explosive earnings growth.
We are talking about quarterly profits exploding by 70% or more.
His golden rule: never buy cheap stocks, ever.
This is totally anti-common sense. Everyone from your grandfather to your financial advisor says buy low, sell high.
O'Neill says that is absolute garbage.
Why is it garbage? Let's explain the PE ratio, price to earnings.
People look at a stock's price relative to how much money the company makes.
A low ratio means the stock is cheap. A high ratio means it is expensive. Everyone tells you to buy the cheap ones.
But O'Neill realized that a low price usually means the company is terrible. It is cheap for a reason.
Maybe their products are failing. Maybe their management is corrupt.
The true monster stocks, the ones that go up 10 or 20 times in value, always look horribly expensive right before they launch.
The true starting line for massive wealth is a historical price high.
Think about buying a racehorse. You want to win the Kentucky Derby.
You do not go to the bargain bin and buy the cheap, slow, crippled horse, hoping it suddenly becomes fast.
You pay a massive premium for the champion. You buy the horse that is currently breaking track records.
You buy extreme strength. You buy proven winners.
O'Neill created the system. It is brilliant logic. But his famous disciple, David Ryan, proved how incredibly painful it is to actually execute that logic in real time.
If you treat your stocks like family members, they will absolutely bankrupt you.
David Ryan won major national trading championships. He hit 1,379% returns over a 3-year period.
He was a god, but before that glory, he completely bled out.
He took a $52,000 account and slowly, agonizingly crushed it down to $16,000.
He was bleeding cash every day.
His redemption was brutal. He didn't find a new indicator.
He created a physical diary of his own pain. He printed out the charts of every single losing trade he made.
He wrote down exactly what he was thinking when he failed.
Yeah.
He instituted a ruthless 7% loss limit.
This is where retail investors fail. They refuse to look at their ugly losses.
When a stock plummets, they hide the brokerage statements. They delete the app from their phone.
They don't want to look at the red numbers.
Ryan forced himself to stare at his losses until the psychological pain literally rewired his brain and made him a champion.
Why do people hold losing stocks? Mechanically, why do we do it?
It is a massive psychological trap. Selling the stock makes the loss real. It finalizes the failure.
As long as you stubbornly hold the stock in your account, you can pretend it will bounce back.
Holding it keeps the delusion of hope alive. Hope is the most toxic emotion in finance.
Hope is literal poison. It kills accounts faster than leverage.
Marty Schwartz had to completely kill his own ego to cure himself of that hope.
Schwartz was a brilliant, highly paid Wall Street analyst. He wrote incredible, deeply researched reports.
He knew everything about corporate balance sheets. He knew the CEOs.
And he spent 9 straight years going completely embarrassingly broke in the markets. 9 years of absolute failure.
How does an expert who knows everything go broke?
Because being an analyst is about being right. Being a trader is about making money.
Schwartz finally snapped. He changed his methods completely.
He stopped trying to prove his research was correct. He hit 210% average returns.
He capped his total account drawdowns at a tiny 3%. It was a miracle turnaround.
Why do retail traders lose? Because they would literally rather bleed cash than admit to the universe that their analysis was wrong.
Schwartz realized a massive, liberating truth. Swiftly cutting a loss preserves your capital.
Admitting you're stupid on a single trade is infinitely more valuable than saving face.
It is exactly like sitting in a burning house. You smell the smoke, you see the flames licking the walls.
But you refuse to run out the front door because you do not want to admit to your neighbors that you accidentally left the stove on.
Run out of the house. Save your life. Forget your pride.
Schwartz runs from danger instantly. The moment he smells smoke, he is out.
But Jim Rogers takes a totally different path. He just watches everyone else burn.
He waits patiently on the sidewalk, and then he walks in when the fire is completely out.
The commodity king goes years without making a single major move. He just waits for the world to go completely, certifiably insane.
Jim Rogers is a legend in commodities. Commodities are raw materials: gold, oil, wheat, sugar.
Rogers famously shorted gold at its absolute historical highs. He bought heavily into devastating market crashes.
He does not trade frequently. He only steps in when the mathematical odds are overwhelmingly, undeniably in his favor.
He waits for total capitulation.
What does capitulation look like? He looks for mass hysteria.
He waits until the money is literally just lying in the corner. There's absolutely zero competition.
Everyone else has been wiped out or is too terrified to buy. Only then does he bend down to pick up the cash.
Honestly, it sounds incredibly boring.
It does sound boring. You just sit there in your office for 3 years doing nothing, reading newspapers.
Where is the action? Where is the thrill?
True wealth generation is not an action movie. It is not constantly pushing buttons.
It is hundreds of hours of agonizing boredom. It is reading, waiting, and watching.
And that boredom is punctuated by moments of extreme, highly calculated violence.
Speaking of calculated violence, Mark Weinstein takes this predator analogy to the extreme absolute limit.
Think about a true apex predator. A true predator never chases a healthy, energetic animal into a dark, dense forest.
It is too dangerous. The prey could fight back. It burns way too much caloric energy.
A smart predator waits until the prey is sick, crippled, and completely defenseless.
Weinstein's track record is terrifying. He hasn't had a losing week since 1980.
Let that timeline sink in. Decades without a red week.
He blends the extreme patience of a cheetah waiting silently in the tall grass with the quick, darting strikes of a sparrow picking up isolated crumbs.
The amateur trader blindly crashes through the woods at night. They shoot at shadows.
They hear a noise and pull the trigger. They just hope to hit a target.
Weinstein waits for the market to completely lose its momentum. He strikes only when the market is physically incapable of fighting back.
Mechanically, what is a defenseless market?
It is a market that has trended in one direction for so long that every single participant is exhausted.
The volume dies. The price just drifts.
Yeah.
There are no surprise buyers left to ruin his trade.
He steps in, takes his profit, and steps out before anyone notices.
Retail traders are like drunk guys getting into bar fights with strangers. They swing wild, they get punched in the face.
Weinstein is the guy who only enters the fight when his opponent is already completely unconscious on the floor.
It isn't fair. It isn't brave. It is purely systematically profitable.
Weinstein watches the momentum fade on the charts. Brian Gelber does something much more visceral.
He listens to the actual screaming of other humans.
When a top-tier institutional trader calls another top-tier trader on the phone, they do not ask for friendly advice.
They call to listen to the panic in the other guy's voice.
Gelber went from being a gold star, highly successful broker to an elite trader.
He built a massive network of contacts across the industry. But he didn't use that network for stock tips.
Stock tips are worthless. He used his network for psychological recon. He wanted to hear their fear.
Explain how he used that fear mechanically.
There was a massive Japanese market squeeze.
What is a squeeze?
A squeeze is when people who bet against the market, short sellers, are forced to buy the stock back at rapidly inflating prices to cover their catastrophic losses.
Their forced buying pushes the price even higher, causing a vicious, exploding cycle.
Gelber was caught in one. He took a massive $400,000 loss instantly.
He took it to avoid a fatal $1 million blow.
Retail traders die in a squeeze because they stubbornly defend their original predictions.
They say the market is wrong, I am right, it will go back down.
Gelber survives because he listens to the sheer terror of the crowd, realizes he is caught in stampede, and reacts instantly by taking the loss.
He raises a dark ethical question. Isn't it arrogant or even cruel to prey on the fear and panic of others?
It feels cold, it feels predatory. You are literally making millions off someone else's worst day.
The market is not a charity. It has no morals. It has no feelings. It is simply a mechanism.
It is a highly efficient machine designed for transferring wealth from the emotional to the disciplined.
If you are emotional, you will voluntarily hand your money over to the disciplined trader.
If you want to survive that brutal wealth transfer, you have to completely numb yourself.
You have to erase your entire concept of what money actually means in the real world.
The exact millisecond you calculate how many cars or vacations or houses your current open trade could buy, you are already dead.
You have lost your objective edge.
Tom Baldwin embodies this perfectly. He started with just $25,000.
He eventually scaled up to trading $2 billion worth of treasury bonds in a single day.
$2 billion in one single trading session.
In the deafening roar of the Chicago trading pit, surrounded by screaming men, Baldwin had zero fear.
Why? Because he completely disconnected the flashing digits on the screen from the concept of actual cash.
You must surgically extract your reverence for money. If you respect the money too much, you will freeze.
You cannot survive massive volatility if you are worried about paying your mortgage.
Let us unpack this disconnect. It is exactly like an elite trauma surgeon operating on a human heart.
If the surgeon looks down and thinks about the patient's family, his hands will shake.
He will feel the weight of a human life. He will freeze.
To save the life, he has to view the heart as just tissue and plumbing. It is just a mechanical fix.
Baldwin sees the market as just numbers flashing on a screen, nothing more.
Baldwin trades raw, naked volume with no fear. Tony Saliba, on the other hand, trades using incredibly complex armor.
How do you sleep at night when you have millions of dollars on the line?
By actively planning for the total catastrophic collapse of the global economy every single day.
Tony Saliba achieved an unbelievable 70 consecutive months of over $100,000 in consistent profits.
During the infamous 1987 crash, while other traders were screaming and going bankrupt, he was laughing.
He made an absolute fortune while the world burned.
How? He never trades naked. Naked means you just buy a stock and hope it goes up, with infinite downside risk.
Saliba uses complex option strategies, specifically butterfly spreads.
Let us explain a butterfly spread without the jargon. Imagine you buy a massive, expensive insurance policy against a hurricane destroying your house.
But the premium is too expensive.
So you simultaneously sell a couple of smaller, highly specific insurance policies to your neighbors.
The small premiums you collect perfectly pay for your massive policy.
You are perfectly hedged. Your maximum loss is mathematically capped before you even begin.
His rule is incredibly simple but profound. When stealing second base in baseball, keep one hand firmly on first.
Before he places a single speculative bet, he has already mathematically calculated his exact survival in a worst-case black swan disaster.
But I have to play devil's advocate. Paying for all that complex insurance eats up your daily profits, right?
Why drag that anchor around when the sun is shining?
Yes, it eats into your daily profits until the hurricane actually hits.
Then you are the only person left alive who owns the entire town. Everyone else is wiped out. You buy their assets for pennies.
We have just walked through 16 different paths to massive wealth. 16 absolute wizards.
But if you strip away the noise, they all converge at one single undeniable point.
Erase everything you thought you knew about technical versus fundamental analysis.
Erase the chart reading. Erase the crop reports. Erase the economic indicators.
In the deepest, darkest core of the market, every single wizard operates identically.
If you map the psychology of these masters, they share a 100% overlap in three distinct areas.
1. An extreme, almost psychotic desire to win and master the game.
2. Fiercely independent thinking. They do not care what the crowd thinks.
3. Draconian, merciless risk control.
They do not predict the market. Predictions are for fools on television.
Fortune tellers go broke. These wizards simply manage risk. They execute their discipline without a shred of mercy.
They accept small losses as the absolute non-negotiable cost of doing business.
They are not gamblers. They are casino managers, running a calculated mathematical edge, day in and day out.
They trust their proven process over their temporary emotions.
Which brings us to the ultimate question for you, the listener.
Look at financial history, from the 1637 tulip mania in Holland to the Great Depression in 29 to the modern tech bubbles.
The slaughter is historically scheduled. The timeline of wealth destruction is completely cyclical.
It will absolutely happen again. A crash is mathematically inevitable.
The market will plunge. Panic will set in. The only question is, what exact role will you play when it happens?
Ted Seikoda's haunting words echo back to us. Everyone gets what they truly want out of the market.
The market is just a mirror reflecting your subconscious. What are you actually looking for when you open your brokerage app?
Are you looking for cheap thrills? Are you looking for sympathy? Or are you looking for absolute cold-blooded financial freedom?
Before you ever place another hard-earned dollar into the market, you must deeply, honestly question your own motives.
Are you trading to stroke your fragile ego? Are you trading just to feel alive on a Tuesday morning?
If so, you will be slaughtered. You will become part of that 6-month wipeout statistic.
Are you ready to strip away your ego and face the market as the brutal machine it truly is?
If you want to dive even deeper into the specific hedging secrets and raw data of these top traders, think about how valuable a comprehensive single-click research report of all their core metrics would be.
You can actually grab a fully detailed PDF research report that maps out all their hedging strategies and core data.
The blueprint for survival is out there. The chase to use it or ignore it is entirely yours.
You think the financial market is a fair playing field?
Step into the mirror and find out.